More than $5 trillion. Gone. Gold just crashed through $5,000 an ounce in a matter of hours. Silver fell even harder, below $100, a level nobody expected to see today. And if this feels sudden, if it feels violent, that's because it was. But this wasn't random. This wasn't panic. And it definitely wasn't an accident. Something changed overnight. And most people haven't realized what it was yet. Because while everyone was watching prices, the real shift happened somewhere else. Quietly, behind closed doors, institutions repositioned, liquidity vanished, and the rules of this market were rewritten in real time. By the time headlines caught up, the damage was already done. Let me be clear about something. This sell-off didn't start today. It started weeks ago with positioning, with crowding, with everyone leaning the same way. Gold was up nearly 20% this year. Silver almost 40%. That kind of move doesn't happen quietly. It creates pressure, it creates leverage, and it creates fragility. So when the narrative cracks, price doesn't fall. It collapses. Stops get hit. Margin gets called. Liquidity disappears. And once that chain reaction starts, there's no pause button. No time to think. No time to exit calmly. Just forced selling layer by layer. What you saw today wasn't fear. It was structure breaking. And when structure breaks, the move always feels violent. Now let's talk about silver, because this is where people get confused. Silver didn't fall 10% because it's weak. It fell because it was crowded, heavily. Leverage was extreme. Futures, ETFs, options, all leaning the same direction. When the unwind starts, silver doesn't step down. It drops through the floor. Liquidity vanishes first. Buyers step back. Spreads widen. And every forced exit pushes the next one closer. That's why silver always moves faster. That's why it always moves further. Not because it's broken, but because it's built this way. Here's what most people are missing. This move wasn't about gold. It was about the dollar. The market was positioned for a weaker dollar, for debasement, for erosion. Wars changed that equation, even temporarily. And when the dollar stabilized, metals paid the price. Once prices started falling, risk models kicked in. Margin calls, position limits, forced liquidation. This is where selling feeds on itself. Not because fundamentals changed, but because balance sheets did. That's how you get waterfall moves, even in safe havens. And you could see the stress immediately. Silver down nearly 20%. Gold sliding. ETFs bleeding capital. Not because the story is dead, but because the trade was too full. When everyone's on the same side, the exit gets very narrow. This is the part people hate hearing. Even good assets sell off. Especially when narratives run too far, too fast. Especially when gains feel easy. Gold didn't fail. Silver didn't break. Positioning did. If you've watched markets long enough, you've seen this before. Fast up, fast down. Same pattern, different asset. October showed us a preview. This was just the sequel. Louder, faster, more violent. Now let's talk risk, because ignoring it is dangerous. If the dollar keeps strengthening, if rate expectations stay firm, metals can stay under pressure. Crowded trades take time to reset, and volatility doesn't vanish overnight. That's the reality. So where does that leave us? Watch the dollar. Watch Fed messaging. Watch positioning, not headlines. Corrections feel like the end until they aren't. Do your own research. Manage your risk. Stay disciplined. This market isn't broken. It's being repriced. Stay focused. Stay disciplined. Invest with logic.